Well, good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Tuesday. It's the second day of the week of the second trading week of March. The market's going to open up in about an hour and 20 minutes. I want to give you a nice little briefing before the market openings so you know exactly what to do after the market opens. Now, the futures are up pretty good right now. The S&P E-mini, before the opening, it's up about 0.88, trading above the 50-day moving average. Very impressive. Yesterday, we traded mostly above the 50-day moving average. Now, you guys know my rule. I'm not going to call this market bullish again till we completely trade above the 50-day moving average, which means no part of the bar touches this blue line. Kind of like this type of trading action, like these 2 days I want to see. Or these 2 days, or these 2 days. See, none of these 4 days touch the blue line. Whereas here, it looks like we're about to touch it on the opening session, probably. And yesterday we touched it. So we are still far from being bullish. 2 complete days of clearance, either above or below. Otherwise, we're still neutral. Now, the Nasdaq's looking a little worse. The Nasdaq is up almost 2%. It was down about 1.5% yesterday at one point, but it went higher. The stimulus bill is offering a lot of liquidity into the market, or stimulus, not bill, it's a stimulus program. It's already passed. But we're still in the twilight zone, which is the difference between the 50-day moving average and the 200-day moving average. And the question is, are we going to go higher or are we going to go lower? Well, here's my answer for you. And I told you, I saw this coming 4 months ago. So if you look at the number of stocks trading above the 50-day moving average, it looks like we're getting close to the bottom. We can go a little bit lower. We can go about 20th percentile, which means another 10% of stocks would another 10 stocks, 10% or 10 stocks, because there's only 100 stocks, would trade below the 50-day moving average. So I think we're getting close on the short-term basis to bottoming out and or bouncing. I think there's only a little bit more to go before we bottom out. We may be close, but there's always a but, right? On the longer term view, if you look at the number of stocks trading above the 200-day moving average, we just crossed below the 60th percentile. We went from 90 stocks trading above the 200-day moving average to 60 stocks. But if you look at this level here, it looks like we can go down quite a bit more, because every time we go up to these levels, we tend to go down all the way to the 20th percentile. And if we're going to go down to the 40th or the 20th percentile, then the number of stocks trading above the 50-day moving average is literally going to go down to about 10 percentile. And that's the most or more likely scenario, which means the number of stocks trading above the 200-day moving average will probably go to about 40th percentile. And that would put the Nasdaq right here at the 200-day moving average. So as of right now, unless we could have a little pop, we can have a bounce from these levels and we can go a little higher. But the bottom line is, I'm not happy with where the number of stocks trading above the 200-day line are right now. We are in a downslope, and we already know that interest rates are increasingly sensitive to large cap tech. Large cap tech, nothing else but large cap tech for now. Although it's spilling a little bit into the broader market because there's just so many large cap techs in the S&P 500 and even in the Dow. But for the most part, it's limited to the Nasdaq 100, and you could see here the momentum levels are just nuts. So I'm thinking we're going to sell off a little bit more. Now, the Nasdaq 100, we are neutral right now, so we don't want to go long or short, although there are some stocks in the Nasdaq 100 that are trading below the 200-day moving average, and those are prime for short opportunities, and I'm actually going to talk about some of them later today or tomorrow. But for now, be very, very cautious of the Nasdaq 100, especially when you consider the fact that the number of stocks trading below the 50-day moving average is now at 28%, and the number of stocks trading above the 200-day moving average is now at 60%. And if you look at it historically, over 20 years, which is what we're looking at, anytime we go to the 90th percentile, we tend to cool off and go back to the 40th or 20th percentile. And I expect that to happen. We'll wash out, and then it's too early in the morning still here. And then large cap tech should go up. Now, the biggest factor that's influencing large cap tech is this bond market. Look at the long-term bond. This is the T-bond, which is like a 30-year market. If you look at TLT, this is the 10-year market. They're doing exactly the same thing. But as you can see here, it looks like we bounced, we're going higher, and it looks like we're reverting back down. I don't think we're going to go much higher. I think the truth is interest rates are going higher. Long-term rates are going higher. So maybe we'll huff and puff here a few more days, but eventually we revert lower. And that's how the downtrend goes. We huff and puff for a few days up, and then we go lower. We huff and puff, and then we go lower. And now we're looking to huff and puff up a little bit, which is why the S&P is up 0.88% and the Nasdaq is up 2% because interest rates are going, yield is going lower, bonds are going higher. Whenever bonds are going higher, that means yield is going lower. Remember, there's an inverse relationship between the bonds, the bond market, and the stock market. So when bonds go down, stocks go up. When bonds go up, stocks go down. So again, there's an inverse relationship between the two. And with this interest rates right now, with the yield, let me go to the yield. Where are we? With yield going lower, stocks are going higher. With yield on rates going higher, stocks go lower. So especially the large cap techs. So there's a definite inverse relationship between interest rates or a positive relationship between bonds and large cap tech. So keep your eye on the long bond market. Now, let's talk about global economy real quick, just to give you an idea. There's no major news coming out today, although we have some important inflationary CPI and PPI data coming out later this week, and we'll cover it. But as far as right now, global shares were mixed Tuesday, cheered by the expected passage of the U.S. stimulus package, although the optimism was tempered by worries about inflation and COVID. Although I think it looks like COVID is starting to get more and more under control. At least that's what the stock market is seeing. A lot of the back to normality stocks are making a big impact right now and are making trending higher. Revised economic data for October through December in Japan released Tuesday showed the Japanese economy grew at an annual pace of 11.7%, weaker than expected, but not that bad. Quarter to quarter, the growth was 2.8%, revised from 3%. And remember, Japan is the third biggest economy in the world, so this is important stuff. Public-private investments was not as strong as initially thought, but Japan's economy expanded at 22.8% in the July through September period that followed a sharp contraction as the pandemic slumped tourism, trade, consumption, and production. We already know that. Now let's talk about interest rates. Yields have been climbing. Bonds have been going down. Remember, they're opposite, they're inverse, with rising expectations for growth and inflation that could follow. Very much so, and I think it's going to happen no matter what. But I think a reasonable amount of inflation is already priced into the U.S. stock market. Tech companies, large cap tech companies, have been headed lower as investors start to doubt whether their huge gains they made during the pandemic can continue if inflation surges. They are way overbought right now, way overbought, especially stocks that were rising exactly a year ago in the heart of the pandemic. Between March 2020 and September 2020, those stocks are in the crapper right now. Investors have been betting that the $1.9 trillion in coming government stimulus will lift the economy out of its COVID-induced malaise. I think it will. It looks like it will. I was cautious. I was thinking maybe one of these COVID infections would it would create a new variant, and the variant wouldn't be working with the medicine that's out, the vaccines. But it looks like it is. It looks like the vaccines can cover the variants. So it looks like things are moving slowly in the right direction. U.S. economy package, that $1.9 billion package, provides direct payments for up to $1,400 for most Americans and extends emergency unemployment benefits, something that U.S. needs drastically right now, which is a big victory for Biden and Democrats. Oil is rising. It plunged during the pandemic as demand plummeted, but transports are on the rise. It looks like the world looks like it wants to open up again, which means cars, transports, people moving around, which increases the need for energy. Last week, some observers were expecting the OPEC cartel and its allies to lift more restrictions to let the oil flow more freely, but they're not doing it. But it looks like the demand is causing the increased demand because there's less COVID. There's more stuff going on in the world. Transports have been rallying. Industrial stocks have been rallying. All these stocks need more oil. So it looks like little by little the supply of oil is starting to make a comeback. Now, I want to talk to you guys about stocks that are going up or higher. Now, these are the 10 major sectors. We're starting to see consumer discretionary get out of whack with technology. Technology and consumer discretionary are always next to each other. For example, let's go a month back. Consumer discretionary technology. Let's go back 3 months. Consumer discretionary technology. See, they're always next to each other. And right now, they're not next to each other. Technology is in 5th place and consumer discretionary is in 8th place. That means the Nasdaq, which holds a lot of the consumer discretionary and the tech stocks, it's out of whack. We know that because we're seeing the stocks come down, and that causes the market to get fragmented. But I'm expecting this fragmentation to move back into tightness. So we could expect either technology to move lower or consumer discretionary to move higher. Based on what I'm seeing right now, I think technology will move lower minus semiconductors. Semiconductors are on a run. We need semiconductors, DRAM right now for electric cars. So you could expect a rally in semiconductors and a downshift in stocks that are not related to, in tech stocks that are not related to semiconductors, like internet stocks and so forth and so forth. But I'm expecting tech to come down and move in line with consumer discretionary, or consumer discretionary to move back in line with tech. But usually they have to go with each other. The fact that they're fragmented is reflecting on the fact that the market, the large cap techs, are selling off. So I would be very, very cautious with large cap tech right now on the buy side. On the short side, it's a whole different world. And I'm opening to shorting large cap tech if it's trading below the 200-day moving average. As far as long stocks, you want to focus on energy, financial, industrial, and basic material as long as the stock is trading above a year ago's level. If it's trading below last February, March level, it's a dog. It means it hasn't recovered yet. Now, I've got 2 assets that are making downside moves that would make a really good hedge right now against this long correction we're seeing, or would be good shorts. First one, EWZ. It's a Brazilian ETF. Brazil is not doing great right now. It looks like they had a little fun time. Peaked out at about January, about 2.5 months ago. It has broken down. It's now trading below the 200-day moving average. If you look at a long-term trend, you could see it never really recovered. It never really bounced back all the way high after the last February's correction, which is right here. So we're still in a bear market. That's why I'm saying whenever you're shorting something, you want to make sure it has not recovered or has gone below the initial level. And this has definitely gone below the 200-day moving average. It's probably going to go to about 26, and if it breaks 26, it will definitely go all the way to 20. We're at 30 right now, and I would sell this right at the current level and put a buy stop right at the 33 level. And again, I would take profit probably right at this gap right here at the 28 or 26 level. I think this sucker's got a lot more to go and can potentially go to 20 before pulling up. The next stock, boy oh boy, you're going to be upset at me on this one, but I think it's time. I think Zoom has seen its best. I think the expectations for future growth are just so darn high that the stock just can't keep up with growth. It looks like it peaked out in about October, 4 months ago, and it hasn't made a higher high. The stock market, if you look at the stock market, it's been going up and it peaked out in February. But if you look at Zoom looks like it peaked out several months before that, and it hasn't been able to go higher. And Zoom was the leading stock for COVID recovery. This was when pandemic hit, look at this, just exploded. But those days are gone, and it looks like the world wants to go back to normality, which means there's less demand for Zoom. Now, don't get all excited. I think Zoom's an amazing stock, amazing company, has a lot more upside, but the sentiment is changing, and the sentiment is what's driving price. And it looks like the world has spoken, and the world wants to go back to normality. There you have it. So I would be selling Zoom stock. I think the stock can go down all the way to its base, to about the 175 level, possibly the 270 level. It's got a lot of downside. I would sell it below the 200-day moving average, and if it trades above, I would cover my short. But as long as it trades below the 200-day moving average, I think Zoom is a great sell right now. I know it's a great company. I know it's a great fast-growing stock. I know we're going to be using it for many, many years to come, but the valuations have gotten softer, or the expectations of growth are falling behind the level of expectation that's priced into this stock. And I mean, this stock's expectations were just nuts. And finally, we're a little bit past that. The world is coming back to normality, and Zoom is a good short as long as it stays below the 200-day moving average. Now, I've got something important for you, really important. Folks, we've all heard of inside trading. We've all heard of inside trading. It's unethical, and it's indefensible, and punishable by jail. It fits the crime. But this doesn't stop corporate insiders from using this information to their advantage, like a secret weapon, bulking up their wealth. That's right. Meanwhile, everyone else is left scrambling to get in after their shares have catapulted the stock value to new heights. I'm sure everybody got into Zoom after it made new highs, and then look where it's at now. It's in the crapper. Meanwhile, everyone else is scrambling. Now, these corporate insiders are literally pumping their own stocks and doing it 100% legally. We don't know about you, but that does not sound fair. That just doesn't sound fair to me. So, the future of wealth, Lance Ippolito, he's decided to even the odds. Now, I love it. Future of wealth, I love it. Lance Ippolito, this guy's an ex-fund trader. He's decided to even the odds. You got to check this out. Follow the link below to watch this controversial presentation before it's taken down. I'm telling you folks, stop watching these corporate leaders make money 100% return legally while everybody else is watching these stocks drop. It's not fair. How about getting an unfair advantage and evening the playing field, right? Click on the link below and watch this controversial presentation before it's taken down. And make sure to like this video. Subscribe to our channel if you're watching on YouTube. Stay ahead of the market. Be the first to be notified when we post new videos. And have an amazing day. I'll talk to you guys soon, and keep your eye out for these large cap techs on Nasdaq.